Good afternoon, and thanks for joining us Across the Fence. I'm Fran Stoddard. One of the most significant money matters in our lives is housing. Housing is likely the biggest item on our budget. While some people own their homes outright, others are paying back a lender, and still others are paying a landlord. So on today's Money Monday segment, we're exploring why home equities matter. Our guest is certified financial planner Christine Moriarty. Christine is the president of Money Peace in Bristol. She joins us each month to address specific money-related topics. It's great to see you again. Thanks for coming in.
My pleasure, Fran. Great to see you.
So housing. So, you know, in financial news earlier this month, the Federal Reserve lowered interest rates. We hear that. Can you put a perspective on what this means to the average viewer? What do we need to know?
It adds to the consumer's viewpoint on two sides.
Okay.
One is if you're saving money,
right,
the money in the bank is not making a ton of money. As the interest rates drop down, the Federal Reserve, we can't make money on that end. If we're borrowing money, we're going to be able to borrow it at a lower interest rate. And the focus is, for most people, cars and homes.
Right. And so just quickly, what is the Fed and why does it matter?
The Federal Reserve is actually a government agency that, independent of politics and the should be, yes.
For the most part is.
And Wall Street adjusts the interest rate so that we have a more balanced economy. They look at what's unemployment, what's going on Wall Street, and try and keep things stable for us.
Okay.
And when they set a rate, we don't get the rate they set, but we get typically that rate plus
a little
bit more, depending what we're buying.
Right, so, especially when we're borrowing.
Right, so when you hear they drop something to a certain point, don't think you're going to get that rate.
Right, okay. So since many of us have a mortgage, what should we be looking at? And how does the Fed, impact our mortgage?
So here's the thing. If you already have a mortgage on a home, you might have a fixed or a variable rate. If you have a variable rate, it might not be variable as much or adjusted as much now that the rates have dropped. Right. If you have a fixed rate, look at the rates today and say, here's my fixed rate. Is my fixed rate 4%? But now I could get one for 3.5.
Right. So you might want to look at that and shift.
Right.
Possibly.
So just understand first which you have.
Right.
Fixed or variable.
Right. And then what kind of mortgages are there? There's certainly the traditional that many of us know about, and then there are other types of mortgages.
There is. So when you have a traditional mortgage that when you first go to buy a house, it's usually you get a 30-year mortgage. Right. You can get them for a little bit shorter as well, but a 30-year mortgage, that's called a first mortgage on a house. So that means that the bank has first dibs if you mess up.
Right.
Okay? That's it. So that's a traditional mortgage.
That's the traditional mortgage. So that's the 30-year usually and all of that stuff. So what is a second mortgage? What do you mean by that?
The second mortgage is if there is someone who's in default, after the first mortgage company comes in and takes their money, then the second one is the home equities, which we call home equity and we lump them together, but there's truly a home equity loan and a home equity line, and they're different types of products you get through the bank.
Okay, well let's take a look at that. So the difference between a home equity loan and a home equity line.
Great. So a loan is just like a loan, whether it's a car or a home equity loan, it's for a fixed term. So you get the lump sum up front to improve your house, to do whatever you need to do. It's a fixed rate typically, and it goes between 5 and 20 years. It's limited to 80% of the value of your home, whereas like the first line of mortgage, you can have almost 90 or 95%, which means if your house is worth $100,000, the biggest equity loan you could get is $80,000.
That's still a hefty.
It's still, right, it is. If it's the only loan, it has to be after that first loan.
Okay.
Okay, so Talking if a house was paid off.
I was going to say, because it depend on how much you've paid off.
Right,
whether
how much equity you have in the house.
you still have
right.
in the house.
Right.
So that will influence what you can get in terms of home
what
equity
you can
loan.
get. So I was talking about a home equity loan if you didn't have a first mortgage.
Okay.
So this would still be, you might have closing costs, you might have other fees along the way. A home equity line is almost like a credit card or a credit line, which means you don't get the money until you need it. So they're often called HELOCs, which is why people get confused. Like they both begin with home equity, but the line, you more get a checkbook. And it has a variable rate.
Right.
And it has to be paid off in 10 years. Even though there's different terms, people tell me, well, I'm only paying interest only. On the lines, that's true, but at the end of 10 years, you have to pay it all off at once.
Okay. So
Okay.
why? So there are a lot of details and important details here. When would you choose to get a line rather than a loan, or vice versa?
It could be interest rate, one. It could be the amount you needed. So if you only needed $25,000 to redo a bathroom, it might make sense to get the line because there's low cost, there's no closing cost,
Okay.
and there's no added fees along with it. Also, the equity line is, if you don't really know how much you need, you can take $5,000 instead of the $25,000. Whereas if you got a loan, a home equity loan, and took out $25,000, you'd be paying the interest on it right away.
Right.
So you can take it slowly over time with the line.
Okay. So you might want to start with the line if you can, unless you know
Right.
you have this big
Right.
chunk.
And some people, I say, it's good to have a line just as a backup.
Right. Right. Awesome. So what are the other things people need to consider when it comes to home financing?
Well, you have to consider home financing and home refinancing. Most people just go, oh, what's my payment?
Right.
And we have to do more than the monthly payment because we have to think about the interest rate, how much we can afford, how much equity is in the house, which we've already talked about. When will it be paid off? So, for example, if you're thinking of refinancing and the rate is less than 0.5%, you can get less than 0.5% now difference. So that 4% that you're paying, you can now get 3.5. Then we have to think about closing costs and what's left on the loan. So it's two ways. If you only have 5 years left on a loan, a mortgage,
Right.
you're
Don't
only
go through all that.
Bingo. Yeah, thank you. We don't even have to go in the details. Don't go through all that if you
Right.
only. If you have 25 years left, do not get a 30-year mortgage. You can ask for a 25-year. If you have 20 years, ask for a 20-year mortgage at that same rate, lowered rate. Ask for a 15-year. Banks will do them whatever number of years you want.
So you
People
can
don't
pay it
know
off
that.
a little bit sooner, but you're paying a little bit less. So we really look at that 0.5%.
Yeah, if it's
Might make a difference. So at least that much before you even consider.
Exactly. At least that much. Well said.
Okay.
You're getting ready to do it then.
So are there any downsides to a mortgage?
The downsides are really when you sell, there's going to be a lot more paperwork. It could be also, if we remember back in 2007, 2008, a lot of people were underwater. And so selling might be hard because you owe more than you
Right.
own. So,
Yeah.
that's the decreasing property values. Some people just don't like owning something with the bank. They want to own it themselves, and they might be better off buying something less expensive. So there was something during the housing crisis that they called back some home equity lines and loans. So
Right.
there's always that risk. It's small risk, but
And
just
call back
remember.
means you have to pay it off
you-
right
you-
away.
Right, exactly.
That's a little scary.
It's very scary. It's very rare,
Very
I
rare.
want to say. But
Right.
it's something to consider. Do you want to own it with the bank or with yourself?
Right. So any other refinancing tips? I mean, we talked about at least 0.5%, but refinancing, when should we go for refinancing or even a home equity loan?
When there's some improvements around the house, when you want to look at, you need something, or you're going to buy your first house. I met someone who was 65 going to buy their first house.
Wow.
Great. Shop around.
Yeah, shop around. Don't go to one bank.
Don't go to one. Find ahead of time what the interest rates are. So
Okay.
you can go to banks, credit unions, mortgage brokers, find out what the rates are, find out what their fees are, and find out what their process, like how long it takes and those kind of things. Because you only want to actually apply and get a loan from one place. You don't want to apply to 6.
Right.
You want to gather the information first when you're getting a loan.
And every bank or other lender will have different rates depending on what's going on for them.
Exactly.
Potentially.
And if you are a first-time home buyer, then they might have a special rate just for that first-time home buyer.
Oh,
Yeah.
wow, that's pretty great. So we think about so only 0.5%, and what about if you have this 5 or 6 years left? How do we just look at that quickly?
We look at it, we want to pay it off. You're only paying off principal. So people often keep loans, Fran, just because they say, oh, I'm getting a tax deduction.
Right.
The closer you get to paying it off, you're either getting less or none of a tax deduction. So it could
Okay,
be
so-
totally worth paying it off.
So just pay it
and the
off and
laws
own it
have
yourself.
changed. Right. And own it yourself for that feeling. I'm into the
Okay.
feelings around money. So, and your accountant can help you if there really is a tax advantage.
Awesome.
A lot of times there isn't these days.
Okay, well, excellent advice from certified financial planner Christine Moriarty. Thank you so much for coming in today and helping us out. If you want to find out more, you can go to her website, www.moneypiece.com, or call her at 453-5913. Christine Moriarty, thank you so much for joining us today.
My pleasure, Fran.
And thank you for joining us across the fence. I'm Fran Stoddard.